The Climate of Capital, a comprehensive guide to Trane Technologies, TT. As of February 12, 2026, Trane Technologies, ticker TT, is no longer just an air conditioning company. It has successfully rebranded itself as a global leader in climate innovation. Following a blowout earnings report in late January 2026 and a fresh dividend hike just last week, the stock is currently trading near all-time highs, fueled by a unique catalyst: the massive cooling requirements of AI data centers. For an investor today, Trane Technologies represents a play on the intersection of industrial decarbonization, global electrification, and digital infrastructure. This guide breaks down the new Trane business model, the 2026 data center boom, and the specific valuation risks you must weigh before entering a position at current price levels. 1. The business model: more than just HVAC. Trane Technologies operates through two primary strategic brands: Trane, heating and cooling, and Thermo King, transportation refrigeration. In 2026, the company has pivoted away from being a box seller to becoming a software plus hardware provider. The three-pillar strategy: commercial HVAC, the growth engine. This segment provides climate control for office buildings, hospitals, and increasingly data centers. In 2026, this division is seeing unprecedented demand as building owners are forced to upgrade to electrified systems to meet strict new carbon regulations. Residential HVAC, this serves the home market. While this segment was sluggish in 2024 and 2025 due to high interest rates, it is beginning to show signs of a trough recovery in early 2026 as mortgage rates stabilize. Transport refrigeration, Thermo King. This is the global leader in the cold chain, ensuring food and medicine stay cold during shipping. In 2026, Thermo King is leading the transition to fully electric refrigerated trailers, e-trailers, removing diesel engines from the global logistics fleet. 2. The 2026 catalyst: AI and the cooling crisis. The most significant development for TT in February 2026 is its aggressive expansion into data center thermal management. The LiquidStack acquisition, February 2026. Just this week, Trane announced the acquisition of LiquidStack, a leader in immersion cooling. As AI chips, like those from NVIDIA, get hotter and more powerful, traditional air cooling is no longer enough. Data centers are switching to liquid cooling, and Trane is positioning itself to be the plumber of the AI age. The backlog advantage. Trane enters February 2026 with a record backlog of $7.8 billion, up 15% from last year. Of that, the Americas commercial HVAC backlog is up a staggering 25%. For an investor, this provides incredible revenue visibility. The company already has orders on the books that will keep its factories running at full capacity well into 2027. 3. Financial performance: growth by the numbers. Trane's financial profile in early 2026 is characterized by operating leverage, meaning they are growing their profits much faster than their sales. Key 2026 forecasts and results. Stock price momentum. As of February 11, 2026, TT stock jumped nearly 11% in a single week following its 2026 guidance release. Earnings per share, EPS. Management has guided for 2026 adjusted EPS between $14.65 and $14.85, which represents a 12 to 14% growth over 2025. The 2026 dividend increase. On February 4, 2026, the board approved a 12% increase in the quarterly dividend to $1.05 per share, $4.20 annualized. Trane has paid consecutive dividends since 1919, making it a sleep well at night holding for income seekers. Margins. The company's EBITDA margins are hovering around 21 to 22%, a structural improvement from the 17% levels seen just a few years ago. 4. Digital transformation, the brainbox advantage. A major part of the investment thesis for TT in 2026 is its digital services revenue. Trane is no longer just installing a chiller and walking away. They're using AI to manage the building's energy. Trane Cloud and Brainbox AI. Through its partnership and integration with Brainbox AI, Trane systems can now predict weather changes and adjust a building's cooling before the heat wave hits. Recurring revenue. This software as a service model, SaaS, provides high-margin recurring income that makes the company less dependent on the boom and bust cycles of new construction. 5. Investment risks. Is the price too high? While the fundamental story is strong, 2026 presents specific risks that every investor must consider. Valuation. The AI premium. Trane Technologies is currently trading at a price-to-earnings PE ratio of approximately 35.9 times. This is significantly higher than its historical average of 22 to 25 times. The market is essentially pricing in perfect execution on the data center story. If data center growth slows even slightly, the stock could see a significant re-rating downward. Residential softness. Despite the commercial boom, the residential market is expected to be flat to down 5% in the first half of 2026. If the recovery predicted for late 2026 doesn't happen, it could drag on overall earnings. Tariff and supply chain sensitivity. As a global manufacturer, Trane is sensitive to trade wars. In early 2026, rising protectionist policies in Europe and the US could increase the cost of raw materials, steel, aluminum, and electronics, potentially squeezing those record high margins. The crowded trade risk. TT is a favorite of institutional ESG, environmental, social, and governance funds. If there is a broader rotation out of green industrials and into deep value sectors like energy or banking, TT could face selling pressure regardless of its individual performance. 6. Competitive landscape, TT versus Carrier versus Lennox. In the climate war of 2026, Trane is currently winning the battle of the multiples. Trane, TT, focused on high-end, complex commercial systems and data centers. It carries the highest valuation because of its software and data center exposure. Carrier Global, CARR. After selling its security and fire businesses in 2025, Carrier is now a pure-play HVAC company. It is generally cheaper than TT, but has lower margins. Lennox, LII, primarily a play on the U.S. residential and light commercial market. It lacks the global scale and cold chain exposure of Trane and Carrier. 7. Strategy. How to trade TT in February 2026. Given that the stock has just surged 18% year-to-date as of February 12, 2026, your entry strategy is critical. The wait for the pullback approach. Many analysts, including those from JP Morgan, have recently moved to a neutral rating, not because they don't like the company, but because the price has run too far too fast. A healthy entry point would be during a market-wide breathtaker, looking for a price closer to the $430 to $440 range. The dividend growth strategy. If you are a long-term holder, the yield of 0.9% might look low, but the 12% annual growth rate of that dividend means your yield on cost will be very attractive in 5 to 10 years. The AI hedge. If you want exposure to AI but are afraid of the volatility of semiconductor stocks like Nvidia, TT is a secondary way to play the trend. You aren't betting on which chip wins. You are betting that all chips need to stay cool. Conclusion. Cooling the future. Trane Technologies, TT, enters the middle of 2026 as a premier industrial compounder. It has successfully linked its fortune to the two most powerful trends of the decade, the energy transition and the AI infrastructure build-out. While the stock is undeniably expensive by traditional standards, its record backlog and high-margin digital services provide a cushion that most industrials lack. The verdict. Trane is a best-in-class company that is currently trading at a best-in-class price. For the patient investor, it is a core holding in a modern, sustainable portfolio. But in early 2026, disciplined entry, buying on dips, is the key to avoid valuation fatigue.